Welcome to this class where we'll introduce you to the fantastic world of cryptocurrency futures trading. If you come from the traditional market and have traded futures contracts before, then you know that this is a market with very high leverage that allows for significant financial returns, but also carries the risk of losses in the same proportion. In the case of cryptocurrencies, it's a little different. Here, you have more options to customize the leverage of your trades, and throughout this class, I'll explain how to do that. First things first, let's recall what leverage is. Leverage is basically a way to increase your trading power by multiplying the size of your position. However, you need to allocate a certain amount of capital in your account as a margin to cover possible losses. And in some cases, your position may be automatically liquidated if the accumulated losses reach a certain percentage of the margin defined in advance by your exchange. Leverage in futures trading is known precisely for the possibility of multiplying your capital, and it's a commonly used method by day traders who seek to make short-term trades. To make leveraged trades, you need to inquire directly with your exchange about sending funds to your futures wallet, which is separate from your spot wallet. Now that you understand what leverage is, let's explain the difference between the spot market and the futures market when it comes to cryptocurrencies. Basically, in the spot market, you buy the actual cryptocurrency. This enables you to transfer the asset between accounts and withdraw the cryptocurrency to your wallet. In the futures market, the operations are carried out based on the cryptocurrency's price, and you don't have to have the asset in your wallet. In other words, you cannot transfer the cryptocurrency to your wallet, and the outcome will be the financial value of the trade. Moreover, there are traders who use this market to make cryptocurrency hedge trades, which reduce the trader's risks and usually go in the opposite direction of the investor's main position. Now let's dive deeper into the futures market, and it's important that you understand the differences between the two types of margin, the cross margin and the isolated margin. Because when you access Vector to make your futures trades, you'll have to choose between these two margin types. The first one is the cross margin. You'll use all the margin in your account as collateral for the trade. This will increase your liquidity point, providing less risk of being liquidated if a wrong trade goes against your position. However, with this type of margin, if your position is liquidated, the loss will be according to the total margin of your account. In the case of the isolated margin, the story is different because only the value you delimited as margin will be used in the trade. In other words, if you enter a trade with $10 using isolated margin, and your position is liquidated, only those $10 will be lost, preserving the rest of your margin. However, your liquidity point will be shorter than with the cross margin, which may put your trade at risk if there's a volatility spike in the market. Now, remember that at the beginning of the class, I mentioned that you can select the leverage of your trade? Let's understand how that works. Choosing leverage is simple, and the calculation is also straightforward. It can range from 1 to 125x, depending on the exchange. For example, let's say you're entering a trade using isolated margin with $10 and have set the leverage at 20x for the trade. In other words, the equivalent size of your leveraged trade will now be $200. Just multiply the trade size. And most importantly, your profit or loss will be leveraged accordingly. A 1% variation with a 20x leverage means a 20% profit or loss. This example also follows the same logic for cross-margining. So, you must have realized already that trading in the crypto futures market involves certain risks, right? So, be very careful when you start this journey. Always remember you need top-tier risk management in your operations so as not to unnecessarily put your money at risk. And remember, never put an amount in your trades that brings you close to the risk of total ruin of your account. Well, that was a lot of information, wasn't it? But don't worry, let's review everything we've seen so far. Leverage is a method that multiplies your available capital to carry out trades, and you can choose the size of this leverage, which can reach up to 125x in some cases. There are currently two types of margins in the crypto futures market: cross-margining and isolated margin. Cross-margining is the one that puts your entire margin as collateral for your operations. This causes your liquidation point to decrease and reduces the possibility of being liquidated. But it is important to have good risk management so as not to end up suffering from cross-margining liquidation and losing all the resources allocated in your futures wallet. Isolated margin works a little differently. In it, only the resources that you allocated for the operation will be subject to market volatility. That is, unlike cross-margining where your liquidation point falls because of the security of using all the margin in your account. In this case, if the position is liquidated, only the resources that you delimited for the operation will be lost. That is, your liquidation point ends up being shorter precisely because you do not have all your account as collateral in the operation. Finally, remember the importance of risk management. And be extra careful with your operations in the futures market. See you in our next class, when we will show you how to trade in the futures market.